Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was going through the comment section. I'm getting a lot of email messages about the Finding Value website. I wanted to answer kind of everybody because I think it's an important topic. I do share what's in my portfolio. And the way that I build a portfolio is basically whatever good value there is at that time. I don't go like 10% into X, 10% into Y, 10% into Z. Like I don't take that approach. Whatever's at a very good value, and that could any sector, anything. What I do is I overweight that sector in the beginning, and then I continue to deploy money into whatever sectors are undervalued. So in September of 2020, I overweighted uranium and oil. That's where I really got a lot of, I leaned into those positions. I had larger amounts rotating over from precious metals mining companies, because the valuations on the ratios were so ridiculous at the September timeframe for oil and uranium. They were basically dragging along the bottom. Their charts were putting in bottoming patterns, and they were breaking downtrends. So that's when I went big into those sectors. Now I've been adding along the way money into it, but I've been buying other things when they were down, like physical platinum. I've been buying physical platinum when that's down. I've been doing that here recently. So looking at my portfolio and trying to update it real time, since the percentages move so much, I don't think a lot of value. And I don't think it really matters much to someone who's trying to build a portfolio. When you build a portfolio, you have to buy the companies that are down. You can't use price as an indication or a validation of buying something. You're going to have to start using ratios and patterns. That is like a key element, is having trust and having confidence in the ratio game. That's how I buy bottoms. That is how I do it. And I use technical analysis. I rely very heavy on technical analysis, and I look at the monies starting to flow in using volume. You may not see it in a balance sheet. If you were to do fundamental analysis at the bottom of the market with a lot of these companies, what you're basically doing is you're going to prevent yourself from buying something. Now, some companies have incredible value at the bottoms. A lot of the lagger companies, you can start to see their revenue and all that stuff and profits starting to turn around. And perhaps that is, more of your style. I do a little bit of both. I grab everything. If something looks good and money's flowing in, and I think that the commodity is going to rotate this company around, I go heavy into it, because I don't think it's going to go bankrupt based off the volumes coming in. And I mean, some of them are pretty close, and that's the risk that you have to take if you want large, outsized, big short squeeze gains. Is you're going to have to do a little bit of risk on the bottom. And if you're below the cost curve of it, that's where you get all your value, though. That is where the value is made. So when I was buying SM Energy, they had a lot of debt, and there was a lot of people that they jumped on the short bandwagon and pushed that stock very, very low. And there was a risk of them going bankrupt. I just thought that the risk was worth getting into, because they were being charged literally 1% off their all-time highs. And the only way that you can get these large variations is they're going to have something negative about the company. They're going to have too much debt. So Centennial Resource Development, SM Energy, QEP was the other one that I was getting pretty heavy in. And those are the ones that were pushed all the way down to valuation levels that I thought were ridiculous. Now, if they didn't have the debt, they wouldn't have gotten pushed to those levels. So what I'm doing is I'm buying companies that everyone else, for the most part, doesn't like. And sometimes it doesn't work out. That's why you have a position size that limits your downside. If you lose that position, it's not going to kill your entire portfolio. I had that happen in Norilsk Nickel right now, but it's okay. My portfolio continues to move higher, and that's why we allocate certain portions to certain companies. And if we were to lose that, what happens? It does happen. It'll happen to you. Trust me. It'll happen to everyone if you're trying to go out and get 100 baggers, because you have to buy when everyone else doesn't want the company, when it's pennies on the dollar, when they have high debt and their balance sheet doesn't look that good. What you're saying is, well, if oil were to return to $50, $60, $70 a barrel, what does their balance sheet kind of look like? And it's all kind of a guesstimate. It is all estimates and guesstimates, and it's basically a play on the commodity reversing and going higher. So when I build a portfolio, I'm not necessarily doing anything that is 10% or 20% or 30%. I don't even care about that, to be honest. I just buy whatever's the best value in the market. Whatever I think has the largest asymmetric bets, gigantic returns, and then the risk is minimal to the downside, unless it goes bankrupt. I mean, that's the real negative. So when I build a portfolio, the portfolio will morph and be different depending on when I start the portfolio. And if you notice, the one I started in the donations portfolio doesn't look like my regular portfolio. They're not going to match up. Why? Because the risk rewards are different at different times. So it's a very changing dynamic situation where you want to buy companies that are down, and that's where I pile my new money in. That's where I create my new positions, is whatever's down and the technicals look good. So even though I might be sharing my portfolio, and I'm just sharing the positions and I bold out what's overweighted, they became overweighted so much because of how much they've gone up. The other ones will become larger as they go up. So just because I'm overweight in a position doesn't mean that that's the best buy at the second. What I like to do, and I've been giving a lot of general overview kind of picks on the website. When I've got that many picks, I'm not in necessarily all of those companies. What I'm doing is I'm presenting to everyone that these are very good opportunities. And it all depends on what your risk profile is, on what companies that you want to get, and what works for you. Would I go dump a whole bunch of money in a very small, very speculative exploration play? No, but maybe some other people want to. That is completely up to you. And if for me, in my opinion, I don't need to take that much risk. And the risk is twofold. It's not just the risk of losing money, it's the risk of missing an opportunity. So it's what I want in my investments is I want to capture the move. And sometimes it's better to grab something like a royalty company that will for surely capture the move, that has income coming in. A Franco-Nevada, a Wheaton Precious Metals. If precious metals go up, I'm very sure that those will be a leverage play to the move to the upside. It may not be as much leverage as what most people want. But if your exploration company, and for whatever you label it, developer company or exploration company or whatever it is, if they have problems, you might not get the leverage to the move. That is your risk. You could have a missed opportunity in a very good bull market that I think is coming up for all of these commodities. And you don't get these opportunities very often. So I wanted to touch on that. So to recap real quick, my portfolio and how I would set it up is completely different based off of where the companies are at that time. I want to capture the move. I don't want to take on too much risk where I could not just lose money, but where I could miss an opportunity in a sector. Now, each sector is not the same. Each sector is different. And I look at this. I look at it. I evaluate it. For some reason, I think there's a lot more risk in the gold and silver sector of missing opportunities in the exploration companies. Or maybe we're just not there yet. but I haven't seen large correlations of at least small companies yet to move to the upside. There's ones that are obviously very good that have moved good amounts in that March, April, May, June, July timeframe of 2020. So I do think that there's a lot of opportunity there. I am going after it. I just don't know if we're ready yet. That the charts don't look ready to me. Some of them look okay. Other ones don't look ready. So it's a very big mixed bag. Uranium, since there's not many explorers and developers, I think have a better chance of making large outsized returns in that sector based off of how they're moving in relationship to the futures prices, the uranium physical price. So I do think I feel more comfortable to leverage more into the uranium space than I do in some of the gold and silver mining companies. I also think that there's more leverage in that area as well. And then the oil and natural gas sector, what makes me very attractive to that sector is that they have income. They have revenue. They are sticking holes in the ground, getting oil out and selling it. I can't say that for a lot of the junior gold and silver companies. I can't say that for a lot of the uranium companies. So I'm also looking at the value aspect and the revenue and potential cash flow growth in the future. I see the best, when I was looking at all of this, the best areas were oil and natural gas because they had the existing infrastructure in place to increase cash flows. It was a play on the commodity and it was a leverage play on the commodity. So that's what I really liked about it. Now, if you don't have revenues and you don't have, cash flow and revenue, there is the chance that these companies can dilute you. Dilute you meaning they raise money, they dilute the shares. It depends how much assets they have. It depends if they can borrow money. It depends if they even need to do that. But there's the risk of that happening. And uranium has more of that risk than, say, oil and natural gas at the bottom. So what I did is I overweighted the oil and natural gas companies. So why did I do that? Because of the risk. It's not the risk of losing money, it's the risk of losing the opportunity. I want to make sure I get the move. I want to make sure that if something goes up, that I have a leveraged play on that move. And at that time, I thought that the least risk, best reward, highest probability of gaining leverage was in that sector. Now, shipping has some good prospects because they have the infrastructure or the vessels in place. The value's there. And if the shipping rates go up, they're going to make more money. So that is another area that I've been looking at because of not just the symmetry and the value and the ratio of the Baltic Dry Index in relationship to other assets. It also has the infrastructure in place already. And if we go into a future that maybe gets a little bit hairy in terms of being able to build new things because of shortages of minerals, we could see a ship shortage where we squeeze up on the shipping rates. And buying companies that are, some of these companies, if you look, they've got more cash on hand than their market cap in some of these companies. That is ridiculous. I'll probably be, we'll see. There's a company that has, if you were to take their vessel cost or their vessel worth, their acquisition cost, I should say, and you take their cash and then you subtract out their debt, it could go up like 4 or 5x from their current market cap. Problem is the chart isn't ready yet. So I'm reluctant to kind of just throw names out there when they're not ready because I know how much people want things to move up immediately. But there's value plays out there that look incredibly good if you're very patient. So when you're evaluating all of this stuff and you're creating a portfolio, the thing that I overweight or the things that I want to overweight are companies that have infrastructure in place, vessels in place, mines that are maybe able to be put back into operation that could potentially have cash flow. Those are your lower risk bets. Those are a lot lower risk. I think that you have to kind of look at this. If you have an entire portfolio that's all 100% speculative on trying to find stuff through exploration, I just think that you're probably taking too much risk, especially if you've got the size of the commodity bull market that I think's coming. You've got the risk of missing the opportunity. So when I put a lot of these companies in front of people, I'm doing the work. I'm doing the work enough to understand what those differences are. Not all of the companies I'm putting in front of people are the value plays. They may not have an existing infrastructure in place. So the way that I weight a portfolio is incredibly important. It's so important that I could give everyone the same companies and you might not get the same outcome as me, because the way that we weighted the companies could be completely different. And I weighted the companies that could go up 25x versus others who weighted companies that didn't go up as much. And your returns could be completely different. So what I'm saying is you could get all of the timing right. You could get all of the commodity right. You get all of that stuff right. You get the once in a lifetime opportunity of this commodity bull market that's coming that could be this large. And you blow it on how you selected the companies. You blew it on how you picked it. And that's just one minor little thing that could blow the entire returns of everything. So there's a lot of value in having some people experienced with commodities in the commodity bull market to help you along this big bull market. And I think we're going to be doing a lot of talking, I'm guessing, this next Zoom meeting that's coming this weekend. It's 4/16, 7 a.m. Mountain Standard Time, about the companies and what I think are lower risk companies versus higher risk companies, and how I weighted my portfolio. So there's going to be a lot of answers and questions on that, and that's what I'm going to really focus on. I think coming up in some of these Zoom meetings coming up, because we're at the beginning of this bull market. I know some people really want to push the leverage and the risk, but I'm just saying be careful of missing the opportunity. And I do a lot of stuff that people consider very low risk, like buying physical metals, like buying big royalty companies and big diversified mining companies. You know why I'm doing that? Because I want to get the move. I need some money in something that's going to capture the move for sure. And a diversified approach, I think we're going to have so many problems in all of these different commodities that I think I'll for surely capture with those. So just be careful on the company selection, because you can really blow your returns. You can miss your opportunity if you select the wrong companies. That's all I'm going to say. And just because a company is risky doesn't mean you'll get the leverage. I'll say that again. Just because something is risky doesn't mean that it's going to outperform something else that's less risky. What we want to find, what the best things that we want to find in the markets are low risk, gigantic opportunities. If they exist, we need to exploit those and overweight them. The question is, which ones are those? Right? That's why I developed the website. That's why I developed the website, so we can identify those opportunities and where the leverage is, where the risk is, and I'm going to talk about this probably coming up this next Zoom meeting. So if you guys are interested, join the Platinum membership. The website link is in the description link below. The Platinum membership gets you the weekend call, Zoom call, questions and answers. I go over a lot of stuff. I do technical analysis. I go over companies that people ask. I go over questions, give my opinion. And there's a ton of value there. We do it once a week. So I just wanted to bring that up, guys. If you like the content, give me a thumbs up. Subscribe to the channel if you haven't. Let's do this together. Let's rip this market together. You can use my experience. You can use me as a mentor, bounce some questions. Now, I'm getting a lot of questions through the website, like a lot. I can't answer everybody. It's just too much. And I know some people want me to look at their portfolios. They want me to kind of do a fine-tooth comb. And remember, I can't give advice. All I can do is give my opinion. And, I don't know if I have all the time to do everyone's portfolio, guys. So if you want me to do that, what I might do is how I approach the portfolio and answer everyone. So this next Zoom meeting will be portfolio allocation, selecting companies, looking at maybe some of the charts of some of these companies, what I would be buying today, what my allocation sizes would be. I'm going to lay that all out this next Zoom meeting. If that sounds interesting to you, join the Platinum membership, come on that meeting and ask questions. We are at the beginning of this bull market. It's starting to take off a little bit. Again, remember, things don't go in a straight line. Just remember that. And I'll give you my opinion on what to look for and when things actually look like topping patterns. It just takes a lot of technical analysis. We're going to use ratios. We're going to look at our indicators. We're going to see if the generators are stop generating inflation. We're going to look at all that stuff. And again, no one's going to get this perfect. No one's going to get it 100% perfect. But you know what? If we get it 80, 90% right, you're not going to care. The opportunities are so big, you're not going to care. So that's what I'm seeing, guys. We'll see you. We'll see you next time. Give me a thumb up, subscribe, sign up to the website if that sounds interesting. And we'll catch you next time. This is Finding Value.